bring him on. Good morning, Rory.
Good morning.
Thanks very much for doing this. We had Tim on a few weeks ago now talking about UK public-private, and he touched a little bit on this fund, but I do think this is a very interesting trust that you've got here. So without further ado, should you want to sort of just tell us a little bit now about sort of the history and the background to launching this, please, and what you're trying to achieve with it?
Yeah, sure. Look, well, firstly, thanks for having me on. The genesis of this was going back into the early days of COVID, in fact, when myself and Tim, I've been a fund manager for 20 odd years, running pan-European equities. He's been a private equity manager for probably the same amount of time. And we thought, wow, the UK, particularly at the initial stages of COVID, looks really attractive. We're both very interested in smaller companies, and we thought the UK market, given the Brexit overhang and so on, was particularly attractive from a valuation perspective. So we got our brains together. We'd obviously had some experience with SUPP, the old Woodford fund, and we thought, let's do this. Let's get out there. Let's think about what we can offer from a public-private perspective. A closed-end vehicle is obviously the best vehicle for doing private. We think in terms of the sort of democratization of private assets, giving retail investors and, in fact, many more investors the access to private equity. But we want to do something that's exciting, that makes us very differentiated in the marketplace, gives us the ability to pick the best companies, whether they're public or whether they're private. So we felt that valuations across both public and private were very attractive at the time, and hence we thought, right, let's do an investment trust. The additional features would be to say that we really want to focus on growth businesses. So high quality growth businesses. You won't find venture capital businesses in this fund. On the private side, these are growth buyout businesses, and on the public side, out and out, unashamedly growth. The fund itself is going to be about twice the small cap growth rate, probably 2 to 3 times on the earnings line. So it gives our shareholders the opportunity to invest for the long term in some great British companies that are growing very quickly, and that's really, in essence, what we're trying to achieve. The other thing, of course, is that in order for businesses to grow, in order to maximize their growth potential, we felt that there needed to be a fresh equity story within the fund as well. So obviously, fresh equity going into the private side, but also about half of the companies we've got in the fund right now, we've injected fresh equity one way or another, whether it's an IPO, whether it's a placing, but that really is designed to, our belief that the market is very good at discounting the incremental return on capital that good companies have when they issue equity. So, and that's really come through, and we can talk about some examples in a second. So look, I mean, cut a long story short, we're 70%, 68% public right now. We've got 32% private. We'll talk about the breakdown of the fund in a second. So we're making good progress to get towards that 50-50. We may even go more private over time. We'll see how we go in terms of the interest, the opportunity set. But we've been going nearly a year. The fund returns nearly 10%. The NAV is in line with the share price, and we're very excited. So that's it in a headline. I can go on to more details about the fund.
So thanks very much. Goodbye, but we haven't. No, I think let's talk about some of these stocks now, because this is the sort of the real interesting thing. So you've got up there the private things up the top.
Yeah,
I think, am I right? You've done more private stuff than UK public-private has. Is that right?
Well, yes. Obviously, the UK public-private fund was required significant, I'm going to say, restructuring, and so there's been quite an extensive process of understanding all the businesses within that portfolio and crystallising the value with Oxford Nanopore and all the rest of it that I'm sure you're all aware of. So yeah, we put 6 new deals into SBO, the British Opportunities, and these are, as I say, these are typically quite, I'm not going to say mature within the private equity space, but these businesses are generally making money. They're not the early stage venture.
Yeah.
I mean, Graphcore and Rapid are slightly loss making, but it won't be long before they are very, very profitable. And the other ones you can see here are already profitable and either on their way to IPO, or they will be going through some sort of buyout, trade sale, or whatever it takes. We've had, I mean, typically, as I'm sure your listeners know, you don't typically revalue private equity within the first year of purchase. We've had to revise up Rapid already. That company doubled in value within about 3 months after the purchase, and that's obviously been flagged within our with our RNS information. So Rapid is now the biggest holding in the portfolio at about 8%. The other 5 companies are within the top 10, and we've got about 30 holdings on the public side. So you've got about 36 holdings at the moment. We will be looking to do a number of other private placings, private deals in the coming months in order to get to that at least 50-50 split.
So just so I'm clear, so in the public market, are you only buying things that are raising capital, or are you also buying things that you think are cheap?
We're buying undervalued growth, and the objective here, my objective, is that on a 3-year view, the vast majority of the public companies that we've got in the portfolio will have experienced some sort of capital raise. And this is not, we're not buying deeply distressed businesses here. This is about funding growth. This is not about repairing the balance sheet. So, as I said, nearly half the portfolios on this page, in fact, will have raised some sort of equity over the last 12 months. But that's that is part of the process. We want to be injecting fresh equity. We think we've got great British companies, great British entrepreneurs. Let's give them some money. Let's go and make these businesses what they really can be. So we make no bones about wanting to support them as they go through that capital raise process.
Cool, thank you. With the private equity stuff, are you investing directly, or are you ever investing via funds?
These are either direct or co-investments. We're not doing funds within this particular portfolio. Our private capital business, a private equity business, does do all 3, but these are going to be direct or co-investments.
Right. Okay. Thank you. Which actually answers the next question as well. Actually, whether co-investments. Does Schroders end up having sort of control over these companies, or are you investing alongside another manager?
No, I mean, obviously Tim's the expert in this space, but from my perspective, what they do is quite clever. It's they get involved with co-managers who are experts within the particular field, and they ride on the coattails of industry knowledge, history, where that individual private equity company may have done direct ownership in some of these businesses. And so they've got an amazing network, in fact, around the world, but especially in the UK and Europe, of working alongside other private equity players, and they get involved on a co-investment basis. So it's about sharing expertise, making sure that they're in the right companies at the right time. Okay,
thank you. This next slide talks about why mix public and private equity in the same fund. One of the questions we've got here is why did you come up with sort of 50-50 as an optimal split?
Well, I mean, you have to start somewhere, right? So I think what's been a real revelation, I'll come to the revelation, I'll keep you on tenterhooks, but I think, you know, having that opportunity our feeling was that having the opportunity to invest in both public and private, and being able to distinguish what is the better opportunity, be it public or private, having that really broad opportunity set gives us a bit of a competitive advantage on the grounds that there aren't many players out there that are proper public equity investors and proper private equity investors. You combine that expertise and you've got a much broader opportunity set, which is clearly the first point. The second point, and I think this is a paradigm shift in the way the market is thinking about not only investment trusts, but more broadly, is that you can't ignore the fact that these private companies have a different way of operating, a different way of running their business, a different way of looking at their competitors, their supply chains and all the rest of it. And by combining the expertise of the public and the private, we feel that the information advantage, which is the final point on this slide, is becoming really real. And this is what we say by, this is a new paradigm in investing. And it sounds cheesy, I'm not going to deny, but Goldman Sachs put out a report in September this year called, I think it's called Going Private or something. And basically they're talking about all of the hedge funds on the public side now realizing that actually they want to get into the private side. So it's not me saying this is a new paradigm. There's a lot of evidence out there in the market suggesting that you bring the information advantage you think you've got as a public investor or a private investor, you put them together, and hey presto, you've got a really good environment where other people just can't replicate that. And that to me is where we were really offering something that's quite unique with this portfolio in terms of bringing that together. It's going to take time for that to come through, is the truth. But when you are sitting down with a company management and you are talking to businesses both from the public and the private side, Graphcore is a great example. Graphcore is probably going to IPO in 2023 or something, who knows. But actually getting the public investors on side, getting the management introduced to those public investors means that when the IPO happens, we will know this company inside out on the public side because we've benefited from that private relationship. And it means that we're also likely to get a better allocation. We'll understand the IPO process. It means we can own that company right the way through from private into public because of the structure of the fund. We can own both. And it's just a fantastic way of looking at businesses and owning them from start to hopefully when they become really fantastic major contributors to the FTSE 100, hopefully.
So you're kind of agnostic about whether a company is listed or not?
Absolutely agnostic. Yeah. My suspicion, and if you look at the return profile of private equity over time, is that the trust will find probably more ideas on the private side. But at the same time, there can be, in the healthcare space right now on the private side, there's valuations are quite frothy. So, you're probably not going to be getting involved in too many healthcare private deals. But on the public side, there are actually some things we're looking at. So, I suspect that over time, given the return profile, there may be slightly more private, but having that flexibility to look across both public and private gives us a great investment opportunity set. And also it helps us manage the cash more effectively. This fund has had some cash drag this year because we weren't fully invested even on the public side until into the second quarter. But we were able to invest quickly. We're about 90% invested right now. We've got a little bit of cash in order to fund some deals that are coming through on the private side quite imminently. But you can manage the cash. You can get exposure to some great public listed companies, and if there is a requirement to fund one of the private deals, then obviously you can reduce your positions on the public side at the opportune moment.
And now that you're almost fully invested, do you think you'd like to grow the fund?
You bet. And we've got institutional shareholders, we've got private wealth managers in the fund, and we've got individual investors, and everyone we've spoken to are super happy with the way things have gone. Our two main, I'll be careful what I say, but we've got very strong backing from our the major shareholders in the trust, and obviously they're looking to grow this thing. And we've only got to allude to the pipeline we're seeing on the private side to suggest that this has got a great future in the coming 18 months, 3 years, 5 years, you name it.
Something that I'd forgotten about, but a couple of questions have popped up here. Was it set up with a fixed life?
We put a 7-year life on the vehicle because one of the main pushbacks we got at the time of doing the IPO roadshow was, well, how do you know, and what if this thing trades at a discount over time? What are you going to do to ensure the discount isn't too severe, but also from a longevity perspective? So we said, right, we'll put a share buyback mechanism in place, and we'll also do a 7-year life, which will hopefully pull the NAV to par as we approach the end of that 7-year period. Obviously, we're expecting to grow the trust, to give our shareholders. We're targeting a minimum of 10% per annum. Hopefully we'll give our shareholders a decent return, and we will just literally roll that 7-year vehicle into another 7-year vehicle for that second period.
Okay, fair enough. So yeah, okay, how it's structured, fair enough. Sorry. Now, I want to put this slide up because part of the argument for this is investing kind of as a UK PLC. So we had a bit of a bounce in UK post the this time a year ago, isn't it? Really, when the vaccines came out, and then again with Brexit resolved. But do you think UK is still definitely a lot cheaper than most other markets?
Well, I mean, definitely. I mean, I guess the pushback you get sometimes from investors is, yeah, but it's always about banks and financials and energy. That's the only reason why the UK looks cheap. Actually, that's not the case. And this is what we're saying here, is that across a number of sectors in the market, the UK market looks better value than Europe and the US. And what we're trying to do is exploit that. I will say that given the bounce we've seen in markets, that discount has closed modestly. But if you think about the peak discount being around 40%, that's probably now 30, 35. So we are seeing some evidence of that closing. And again, it's not me saying this. If you think about the number of private equity deals that have come in, international private equity companies coming into the UK, taking out publicly listed companies, I think we're running around 17 this year, which is a record. So, if the market and the investor base don't close that discount, then our friends on the private equity side will come and do it for us. And that, again, is one of the reasons for the trust. When we set it up last year, we're talking about great British companies. If we're not careful, we're going to lose these companies to international private equity players coming in and sucking them up for what we would consider very cheap opportunities. And we've got one in the portfolio, Blue Prism. Now, obviously, Blue Prism has had its issues, but we would argue that company is going to be taken out at quite a significant discount to its fair value. We are a tiny shareholder within Blue Prism, so there's not a lot we can do about it. But it's just indicative of the appetite international private equity companies are finding in the UK right now.
Yeah, definitely. Yeah. So this 10% per annum target. A couple of questions to say, how long do you think that can persist for?
Well, when I obviously made an assumption being the relatively conservative public market investor, and you say, well, if we're at 50% in public markets on average, arguably do 7-8%, whatever, in the small cap space, bearing in mind this fund is targeting 50 million to about 2 billion EV. You sort of think, well, over a period of time, then the average market return on the average return on those individual companies on the public side should be mid-single digit, given it's half the portfolio. And if I think about Tim's return profile on the private side, you're looking at high teens return profile annualized over the last 15 years. So you don't have to push too hard to get into the sort of 10% plus return profile for the overall fund. Particularly, imagine if we ended up with a 60-40 split private public. I don't suppose we'll go anywhere near sort of 75%, but you get the gist. So we were trying to be conservative. As I say, we're obviously already there this year broadly. We've had one uplift on the private side. We're obviously a number of the other private companies we've got in the portfolio, we haven't touched those. We're not allowed to for the first year. But you can see there's a bit of meat on the bones, as it were, in terms of those the NAV for the private companies as well.
Okay, thank you. There's a few IPOs that you've put into the fund. Generally, I suppose you think they were all reasonably good value, but generally, are IPOs coming in at attractive valuations?
Yeah, look, we've had the majority of our IPO has been very successful. Tiny Build was one that went up 70%. I think in the first few days, we top sliced that. It's come back a bit recently, but we're very comfortable with Tiny Build. Trustpilot is another one that everyone will be familiar with. That's done pretty well. LendInvest has done okay. So yes, there are one that hasn't done so well is Victoria Plumbing, and that was actually a secondary placing. My sense on that one is it's about the chief executive, and I'm very comfortable with that business on a medium-term view. So, but broadly speaking, we've done very well out of the IPOs that we participated in. And as I said before, actually on the placings that we've done, the market has been very quick to discount the RO, the return on capital that that cash injection is likely to provide going forward. So that's a real, I think, it sort of vindicates our position when we said, right, let's get into some really exciting growth companies and back them with real capital. And the market seems to be doing that for us as we get into these placings as well.
How long will you hold these companies for? Is there a sort of market cap limit to where you'd hold them, or is it about valuation?
It's the reason we chose 7 years is because typically on the private side, the private team will be holding deals between 3 and 7 years. So you can expect some of those private companies to have made an exit by that 7-year period. Obviously, we would, and if we are trading at a discount as we approach the 5-7 year period, then you can imagine we'd start to build up the public side of the portfolio in order to execute the wind down. But if the shares are doing well and we're trading at a premium, then we will recycle that money into more private deals. So on the private side, it's probably around 5 to 7 years. On the public side, there is, as long as we get into the company, all we've said in terms of the prospectus is, as long as we get into the company when it's between a time of purchase between 50 million and 2 billion, we can hold this thing right the way through. And we've got some very good examples both on the public side and the private side. You get into these companies early on, you don't really want to be selling them. I mean, Tim talks about Google and Uber, where they were invested, and you don't want to be selling these companies too early. So we're happy to ride them. We'll obviously be looking at valuations and the percentage of the fund that they occupy. But so we'll obviously be pragmatic. But there is nothing forcing us to sell if they breach the 2 billion market cap.
Okay, cool. Would you ever sort of consider sort of taking something private?
Well, we have, how can I put this? We've been in conversations with 1 or 2 companies that might be being influenced by private equity. We would be fully prepared to invest in or at least offer our opinion and offer our expertise in that process. If a company is persistently undervalued on the public side, and we own it because of the growth credentials that I've talked about, then we have the expertise to facilitate discussions. Obviously, we've got to be whiter than white in terms of rules and regulations, but it is something that we would consider. It's very early days to be considering that sort of thing, but in principle, we've been in approval of that.
Okay, cool. Just a couple of questions about to what extent you want to have significant influence over these companies. Do you think that's important?
Yeah, look, I mean, we haven't gone through the deck, but there's one thing that we said, and I think it's on one of the first slides. We want to make a positive impact on the companies that we're owning, and this is not an impact fund. We're very sustainable. We're not investing in energy. We're not investing in fossil fuels. We're not investing in tobacco or anything like that. This is a very sustainable vehicle, and the way we're playing it, which is very, very consistent between the public and the private, is the company's affiliation with SDGs, which is the United Nations Sustainability Goals, and we are in deep discussion with them about those goals. Are they justified? Some companies can't really affiliate themselves at the moment, but we're helping and we're working with them on that. Graphcore, again, I mentioned, that's a good example where Paul on the private side is engaged with Graphcore to help them through their sustainability journey. Beyond that, the final point on this slide, the engagement. We've written to several companies, and on the public side, especially from my side, we've been talking about, well, what are they lacking from a sustainability perspective, whether it's climate change reporting, carbon offsets, effectively carbon decarbonisation, or whether it's board structure. And we've actually got 2 examples already where the company has said, thank you for your engagement. We are making changes to our board structure in order to get better diversity and so on. So there's hardcore evidence that already we're making a difference, and the whole sustainability journey for Schroders is the #1 priority, and this fund is absolutely no different.
Cool. Okay. Andrew mentioned discounts and private equity when we were talking earlier on. This is one of the sort of banes of our lives we've been banging on. It doesn't really make sense. But if the fund went to a significant discount, would you buy back stock, do you think?
Yeah, we put a 5% discount on it, and then we just need board approval to buy back stock.
Okay, fair enough.
So, but look, we're very early days. I think that if we can get some revaluations on the private side, we've already obviously had one double. If we can get that type of momentum around the private deals, then I'd be very surprised if we trade at a discount. We've been matching. We had a bit of an overhang for a little while. It's obviously quite a small trust. We're now trading at NAV. And the pipeline is great, both on the public and the private side. So we really want to get another couple of deals announced on the private side. People start to believe that this is going to be 50-50 or even more private, and I think that's going to really make people excited in the way that we are.
Yeah, there's no direct guarantee that holding private equity means you go to a discount, because you only have to look at things like Augmentum and Chrysalis, and so. I think you're right. If you perform, then it doesn't really happen. I've got a specific question here about Essential. Can you tell us the story of that one, please?
Well, look, there's a huge digitalization theme in the portfolio, and we are not only prior to COVID with the change in the way we're all running our lives. So. Whether it's e-commerce, whether it's fintech, online banking, you name it. There's a whole digitalization theme going on across the portfolio. There's also an environmental theme with things like Genuit or Volution. But the thing about Essential is people's purchasing behavior is changing, and that is critically being driven by online shopping. COVID only escalated the pace of that shift. So I look at something like a L'Oreal, where typically you go to Boots and you pick up a bottle of shampoo. Now you don't do that so much, do you? Or you might not do that. Certainly, we all know that the rate of online shopping is increasing dramatically. So L'Oreal historically have been masters of the universe in terms of being able to sell product when it's physically visible in the store. They know how to do the marketing, they know how to do the shelf space and all the rest of it, what products to put up, along with the retailers themselves. What do they know about selling stuff online? Nothing really. And there are a number of products. I use L'Oreal, but there are a number of products out there. And so when you get a company like Essential that have got amazing experience, amazing knowledge, that's what they do, that's what they've been brought up doing. They are able to advise producers as to how they should be best selling their products online. And that to me is the way products are being sold in the future. But you need help in terms of positioning your particular brand, your particular product in an online environment. And that's just one example of what Essential are doing. They've obviously got the exhibitions business, which we believe will be sold at some point at the right price when it comes back into profitability.
Okay, thank you. There's one question been asked here 3 times, so I better ask it. What sort of leverage do you think you have on the private equity investments? Do you use debt in them?
I'm going to say because of the nature of the companies. The answer is I don't know exactly. But the nature of the companies that we're buying are, as I've mentioned, they're later stage private equity. So there will be some crossovers, there will be pre-IPOs and all the rest of it. And they are typically profitable or close to being profitable. So we're not buying hugely leveraged businesses on either the public or the private side. So I'm going to say quite low. If you want exposure to massively leveraged private equity companies, then this is probably not the vehicle for you.
I have a feeling actually that Tim might have answered the question if you go back and watch the earlier show, who asked the question, then I think it might have been in there. Okay, and within the listed portfolio, what kind of turnover do you think you're going to have then?
Well, if you think about the average tenure, the average holding period for me as an investor is typically 3 to 5 years. So on the public side, it's going to be low. Public side, it might be 20-25%. But as I've said, hopefully we make the right decision when we buy these companies at the outset. And we want to grow and we want to help these companies develop. And that to me means they're going to be very long-term positions in the portfolio. We have had to sell one position already, which is obviously not planned. But it's a company that IQE that was just very disappointing in terms of their delivery in the semiconductor space. And we can go into detail, but that was quite well, I certainly wasn't expecting it. And we think we were, shall we say, misled by the company, and so that was one exit. We don't expect to sell out of companies very often. We will top slice when we feel valuations are up with events, but we're looking to hold these companies for the long term.
Yeah, and as you can see from this slide, there are quite a few UK companies that can make you quite a lot of money. So
well, this is interesting because you basically take the UK market relative to the US, and actually as a percentage. As a percentage of the market overall, the number of UK 10 baggers is higher than in the US. So it just shows you that if you can get it right, you can get it right.
Good. Well, we wish you every success. So thanks very much for that, Rory. I know it's a bit of a whistle-stop tour around the fund, but I do think it's interesting. It's something that I've been hoping somebody would launch for a long time. So I'm pleased that it's going well.
Great.
So,
Thank you very much for having me.
We'll keep an eye on you, and then we'll maybe get you back on in a year or so and see how it's going. But
look forward to it.
Thank you.
Thank you very much.
Okay.
See you.
We'll be back next week. And actually, and it's quite topical because Helen Steers from Pantheon is going to be talking about a research piece that they've done on shrinking public markets. So the trend towards private equity. So that should be quite interesting. Then we've got our ESG webinars over the 3 days between 16th and 18th November. And as you see, there's a list of people presenting there is growing. 19th November, it's Baillie Gifford UK Growth in the Combi. And then we're talking to David Cornell of India Capital Growth, who's in one of the best performing Indian funds recently. 26th. We'll have a couple more shows in December, and then we're back in January, and Andrew and I are going to be doing kind of round up of 2021. So thanks very much for tuning in today, and we'll hopefully see you soon. Have a good fireworks day.